I'm going to talk for just a moment about qualified retirement plans. It's a refresher course for everyone in here, I'm sure. However, this is where all of America is still taught to hold their wealth. Build your wealth in a qualified retirement plan. So I'm going to run right through them. And like I said, you already know most of this. We're going to look at the traditional qualified plans, IRAs, 401ks, 403bs, but we're also going to talk about the Roth IRAs and the Roth 401ks. Like I said, all of America has been taught to build and hold their wealth there. It begs three questions. Number one, are taxes going to go up in the future, or are they going to go down? We can all agree that they're probably going to go up. I have a 1913 tax form that proves that taxes, I don't care what your bracket is, your tax rate effectively has gone up ever since 1913 when the Internal Revenue Code came into existence. If you look today, just briefly, you could earn the first $20,000 in 1913 was tax-free. If you do the comparison today, in 1913 percentage rates, we could earn $120,000 in annual income and not be taxed. Okay? I just encourage you to do your homework. The second question is, would you rather pay taxes on the harvest or the seed? A little or a lot? All right? The third question, is a dollar worth more today or in the future? Today. It's always today. So all qualified plans violate those three fundamental financial truths. And this is where we're told to put our money. Now, because taxes are going to go up, we're going to pay taxes on a larger amount. If the underlying investment is successful, you being in the real estate, of course, are ahead of the curve. You want to do the self-directed IRA so you can control the rate of return, right? Hats off to you. You're ahead of the curve. But let's just take a closer look at the qualified retirement plan. And I'm using an individual that goes to work at age 19 and a half. So for the next 40 years, they've effectively locked up their capital, because if they access it outside of certain rules and allowances, they pay a 10% penalty. Then it is 100% ordinary income taxable at withdrawal, whether you withdraw it or your beneficiaries withdraw it, right? But then you enter into this magical 11-year period where you can take out as much or as little as you'd like, as often as you'd like, no penalties, but it's 100% income taxable. Then you turn 70 and a half. If I illustrate you living to 100, for the next 30 years, you enter into another penalty period. Because if you don't take out your required minimum distributions, you'll be penalized up to 50% of what you should have taken out but did not. So if we look at this, 80 to 85% of the time, the owner is in a penalty period. And then if we consider that life events happen between now and retirement, we all need access to capital. So a Fidelity statistic says 45% of plan participants at least do a partial withdrawal or a full withdrawal before retirement. And then if you consider the market correction of 2008 and 9, that percentage rate went up to over 70% of plan holders took the penalty, paid the taxes, because they needed access to their capital. So that's the qualified plan. Full of questions today. Who is that designed for? You, your family, or Uncle Sam? The fourth one that should be here is Wall Street. They're designed for Uncle Sam and Wall Street. Okay. Even the Roth IRAs and the Roth qualified plans violate the law of use. If you don't use it, you lose it. Now, I understand you're in the real estate world and investing, and like I said, my hat is off to you. At least you're using your capital, but consider all the requirements you have to go through to do that. Traditional plans that are not self-directed, the average American is violating the law of use. You give up or restrict the control, use, and liquidity of your money, even in self-directed plans. 80% of the time, like I said, you are in the penalty period, and without question, you, the investor, the account holder, the name on the title, always pays all of the fees. It's never going to be any other way. and you have assumed all of the risk. Nothing changes. Another question that's pretty important, and all of you know the answer. See, I'm asking easy questions because I know, and I know you know, right? Who's been most profitable for you in your lifetime? You. It's always you. An investment guru 6,000 miles away is never going to take care of your money or make you more money than you, your God-given abilities and talents. What you need, or should consider, is eliminating the restriction to your capital. Your God-given abilities and talents and access to capital, that's what creates wealth and generational wealth, happiness, and all the rest. This is a suite of calculators created by a friend of ours in Houston, Texas, and it's meant to show the truth of numbers. That's why he titled it Truth Concepts. So it's just a visual calculator that we use in our practice. And we're going to go through a lot of numbers, there's no question, but when it comes to the infinite banking concept, it's a concept. So we're going to add numbers, because if you don't understand this concept, the details don't matter. If you do understand the concept, the details don't matter. Okay? So the concepts that we're talking about, though, for the engineer, the details are absolutely going to support the concept. Real cases, real numbers, and we're going to get there. So concept and real numbers. And that's the challenge that Eb and I have, is to present both of those in a manner without making your eyes glaze over, and then to see the truth of the numbers. Okay? So this is one of the tools that we use. Just consider this for a moment. We're looking at a 30-year time period, and we're using a $100,000 annual income, whether it's single or joint. Then we're saying and using that you can earn a 5% rate of return on your capital. Easy peasy, okay? Over that 30-year time period, earning $100,000, you could accumulate $6.9 million. But you can't earn $100,000 in America today without paying taxes. So I'm using a 30% tax rate. The taxes over that time period cost $900,000, but $2 million in wealth was destroyed. Your account goes down to $4.8 million, but Uncle Sam is happy. And then if you consider debt service, the interest you actually pay for using someone else's capital, or the interest you actually lose by paying cash for assets with your own capital. Okay? I'm using 35%. Let me back up. I can't back up. 35% debt ratio, debt service, or lost opportunity cost. It cost you $1,050,000 over that time period. It destroys $2.5 million in wealth. Thank you, Eb. Okay. So we go from 6.9 million down to 2.4. That leaves the other expenses in our life, which is lifestyle. The kind of car, how nice of a car, where the vacation is, how much you spend on education, lifestyle. 30% is used in lifestyle, $900,000 in cost. It destroys over $2 million in wealth. Now your 6.9 million is down to 348,000, barely over 3 years of income. And then we're going to consider inflation, and we're using the 5% inflation. John Williams at shadowstats.com that he referenced earlier proves that inflation is greater than 5%. So I'm being very conservative. As a matter of fact, everything we show you today is very conservative. We're using, if we make a mistake, it is in your favor. Okay? But let's consider inflation. 5% inflation. That brings the balance down to under $100,000, $80,000 over a 30-year time period, earning $100,000 just doing what you're supposed to do. Live happy, free, and pay taxes. Now, has anyone in the room ever heard that life insurance is a hedge against inflation? Seriously, 3. I'm outstanding. 1 client. You don't count. 5. Great. That's perfect. It took me 14 years in my profession before I ever figured that out, and then I was shown. And granted, I'm not the sharpest guy, on the street, but I'm not slow either. Okay. Life insurance is an absolute hedge against inflation, and we can prove it. Okay? All right. So, what if, here's the equivalent. You would have to earn 10%. Here's what this illustrates. The financial guru says, well, what your problem is you're only earning 5%. You've got to earn a greater rate of return. You've got to find a long-term growth stock mutual fund and earn 10%. So if you earn 10% instead of 5%, that takes you up to over $200,000 in your account. You're still paying your taxes and living your life. They said, well, listen, now you got to eat beans and rice and find the 12% rate of return over a 30-year time period, 12% year over year over year over year over year. If you did earn 12%, that would take you up to $300,000 in the account, barely over 3 years worth of income. Now, what if you could have your money, your capital, operating in a tax-free environment? Not eliminate taxes 100%. Some of us are 2/3 of the way through our life. We may not have another 30-year time period. But what if your capital could operate in a tax-free environment? Just part of the time, 10% of the time, or a third. That, without changing your cash flows, takes the balance up to $242,000. And I have reduced the rate of return back down to 5. All the numbers were reset. And now I'm just saying your capital can operate in a tax-free environment. And then what if you took that tax-free capital, because you have access to it, and you became your own banker? You learned to finance your own automobiles, your own education, your own whatever it is you're going to purchase. And then what if you financed your own lifestyle, vacations, the kind of car? That takes your account, those two items take your account without changing your cash flows to over $766,000. Now, I have said life insurance is a hedge against inflation. If you can mitigate, reduce, control that inflation without changing your cash flows, your account goes back up to $3.3 million. Okay? Life insurance is a hedge against inflation.
Inflation destroys more wealth than any other thing in the world.
Look, taxes destroy more wealth than what is confiscated. Owner's taxation, in my opinion, is confiscation of private property. Okay? So I'm saying you pay your taxes, but the taxes destroy more wealth than they redistribute. Okay? Wait. Now look, to have a comparable over $3 million in the account after 30 years, you would have to earn a rate of return of over 23%, year in, year out, 30 years every year. And the point here that we attempt to illustrate is if you just operate in a tax-free environment, finance your own lifestyle, finance your own debts and purchases, you don't have to worry about what the rate of return is. You don't have to worry about the stock market, what the inflation is. You don't have to worry about all that. All you have to do is practice whatever it is you do for a living that makes you profitable. And it's called the infinite banking concept. This is the text. The author and the creator, the author of this book is Nelson Nash. He's the creator of the concept. There's a lot of good things across the country, but anything after Nelson Nash is either a Me Too product, an addition, and some are outright bastardizations. This is the text. So I just encourage all of you to purchase this book, 92 pages, big print, lots of illustrations, very easy to read. Just read through it. So instead of restricting the money for the next 30 years in your control in a qualified plan, while we're all financing cars, educations, homes, student loans, vacations, real estate, and equipment, this is guaranteed. It's tax-free if you use it correctly. Okay, and it's not complicated, it's not hard, and we haven't and we're not going to get above 3rd grade math. Okay. Number 3, it's creditor protected. Some states vary. In Texas, it's 100% creditor protected. It's liquid and available immediately, and it becomes your account, the cash values, your wealth becomes more efficient with time, and it gets better with use. Now, you think of anything else in your life that you can use, and it gets better and better. Most things wear out and break. This gets better and better. There's 2 foundational concepts you have to be okay with, however, if this is to make sense. And I'm going to carry you through those. Number one is you finance everything you purchase. You either pay interest to someone else when you formally finance, or you give up interest you could have otherwise earned when you pay cash. This is a hard concept for the cash purchaser, but let's just go through the numbers. I'm using the same 30-year time period, the same 5% earnings rate on your capital, and I'm illustrating a $30,000 purchase. Piece of equipment, automobile, whatever it may be. And now I'm going forward over that 30-year time period, and if you had $30,000 earning 5% over a 30-year time period, it would have grown to $129,000. However, you purchased the asset for $30,000, so I take that out. That leaves $99,658. So my point to you is the finance charge of that $30,000 cash purchase was $99,000 over a 30-year time period. Okay, so I may be speaking past some of your life expectancy, some of mine, but we all have children, grandkids, or charities. Just because we may not see the next 30-year time period doesn't mean it's not going to happen. The second concept is the banking process, and I just want to run through that. If I had $100,000 and I put it on deposit at the bank and they were paying me 4%, the question here is, do you know what the bank is going to do with your money? They are, but right before they loan it, they create additional capital and then loan it, right? So out of thin air, they print up new digits and new dollars and create $900,000. So they leverage it, right? And now I've created portfolios. I've got an automobile portfolio and I put an 8% loan rate to that. I understand you can get interest-free financing, but there's also, used cars and second loans and what have you that have a higher rate. Home mortgages, I put 5% on. Lines of credit, I put 9%. Equipment, put 8%. A construction portfolio, I put 8%. Then a commercial real estate, I put 6%. I'm just going to total up very simply all these rates of returns on these portfolios, and it comes to 44%. There's a myriad of ways you can calculate this. For the conveyance of the concept, this is simple, straightforward. The question here is, how much more is the bank making on your money than you are? Anyone want to throw out a number? 11 times. That's great. I'm saying 1,000% more. And I'm being very conservative, especially in low interest rate environments. The most common answer we get is 40. 44 minus 4 equals 40. And I'm going to go through the math for the engineers. Here are the keystrokes, how I got to 1,000. You type in on a simple calculator, 4 times 1,000% equals 40. Now look, y'all can't print money, right? You can't print digits. You have 100,000 on deposit, you can't lend out 900. I can't either. It's federal crime, right? However, right after they increase your deposit, look, the bank does not loan their money, number one. Their money is Tier 1 capital, sits on deposit, guaranteed interest rates, guaranteed payback schedules. They loan your money and money that didn't exist prior to your deposit. We can't do that. But the very next thing they do is they put that money, your money, into motion, or they add velocity to your money, all right? So even though you can't print money, I bet everybody in here has a nice automobile they're going to drive home in, and your spouse probably does too, and you've probably been driving for several years, and you're going to drive for several more years. And I bet you have a nice home that you're going to go to. It has either had a mortgage or you paid cash for it. This hotel has had a mortgage, or somebody paid cash for it, right? There's no other way. Nothing in business gets done without the conveyance of capital, right? So then we all have had lines of credit, credit cards, or equipment, or hard money lending, either side of the hard money loans, construction loans, student loans, and real estate. You can put velocity to your own wealth without risk, okay? Two concepts. Everything has a finance charge, and there's a banking process, whether you participate in it or not, going on throughout all of our personal economies. So it's kind of just a little bit a paradigm shift in thinking. You've not been taught this by the financial world. Doesn't mean it's not true. It's not there. It hadn't been there. So we're just encouraging you to take a little bit deeper look at finance, banking, and properly structured dividend-paying whole life insurance with a mutual company. Okay? So this question is, who would you rather be, the banker or the borrower? The correct answer is you should be the banker and the borrower. The second most profitable thing you can do in your life is finance whatever you're doing that generates your wealth. And if we consider that for a moment, when we go buy a car today, let's say I'm going to go buy a Ford. It doesn't matter if it's a Cadillac, BMW, or anything. If I go purchase a car, the question is this: who makes the most money? The salesman that helped me, the dealer that provided the salesman with the job, the manufacturer that made the automobile, or the lending institution that financed the whole deal? The lender always makes more money. The banker always makes the most money. Nothing changes. Okay, so now we're going to talk about banking with life insurance. How can I really do that? The paradigm shift in thinking is this. Number one, you've been taught to buy life insurance with the greatest death benefit you could possibly get with the least amount of dollars. We want as much cash as we possibly can with the least amount of death benefit because of the characteristics of life insurance, okay? Which is a couple of things. It's based in contract law. It's private property, it's protected property, it's liquid, and it's tax-free. So we all think more about cash than we do death benefits, so that's the first paradigm shift in thinking. How hard is it to do? It's not very hard to do. This is not esoteric. We're not walking off into gray areas of the tax law. The IRS knows exactly what goes on here. As a matter of fact, they've set the perimeters. So as long as we know the perimeters, we stay within them. And there's no tax issue. And here's just a quick look at the perimeters. If life insurance has been looked at by the IRS, life insurance is tax-free because it's a replacement of a loss. It's not an investment. And what is being lost? If I died today, my wife would not only lose me, but she would lose all my income and all my future income. Life insurance, the death benefit of life insurance replaces that loss for my wife, tax-free. Okay? Now, as long as that policy stays in force until I die, and I don't violate this parameter right here, it always will remain tax-free. So as long as it stays in force, and there's a corridor between the cash value and the death benefit, the IRS says, oh, that's life insurance, not an investment, tax-free. No big deal. It is very simple. Then you have to consider the insurance companies. There are only two types of life insurance companies in the world. This is extremely important. There are stock companies and there are mutual companies. Economics 101 says 100% of the profits go to the owners of the company. It's no other way should it be. Your company, you put up the capital, you took the risk, you created the distribution system, you deserve all of the profits because you're the owner. The question is, who owns the companies? Shareholders own the stock companies. They're operated for the benefit of their shareholders. Mutual companies are owned by the policyholders. 100% of the profits of a mutual company goes to the owners of the company. Who owns the company? The policyholders. Very important, okay? But very simple. And then we consider typical whole life insurance versus the infinite banking concept structure. Thanks for watching. If you enjoyed the video, leave a like, and if you think it was helpful, share it with a friend. If you want to see more videos like this, then subscribe down below and click the bell icon so you can be notified when we release new videos. And we are releasing new content all the time. Don't miss it. Thanks for stopping by.